Good afternoon, friends. Welcome to the first online session on financial accounting subject. Friends, we had discussed about the trial balance in our last session. So in continuation with that, let us now move on to the understanding of preparation of final accounts. You all prepare for your examinations throughout the year. But there has to be a parameter to judge your progress, and that parameter are your results. In the similar manner, final accounts is a parameter for any business to judge its progress in terms of profitability and other aspects like assets and liabilities. Hence the preparation of final accounts. Friends, in order to understand the preparation of final accounts, let us try and understand the objectives of the final accounts. Why do we prepare final accounts? Final accounts refer to the various accounts and statements that provide information relating to the progress of any business. As we discussed earlier, these are prepared from the balances of the trial balance. You have learned to journalize the accounts. We have prepared the ledgers based on the journal entries. So throughout the year, the journal entries that we pass and post them into the respective ledgers, and eventually when you take out the balances and put them in the trial balance, the final accounts are prepared finally from the figures of the trial balance. Final accounts are divided into two different parts. One is to judge its profitability. So the profit earned or the loss suffered by any business during a particular accounting period. Financial position of the business is known through the preparation of balance sheet. So the final accounts provide the information related to these two aspects. Final accounts are prepared with respect to or considering a particular business period. Trading account and profit and loss account are prepared in one format, one below the other. It begins with the trading account and ends with the profit and loss account. The other statement under final accounts is balance sheet. Trading and P&L account, as we call it, are together known as income statements. And these are the final summary for accounts that affect the profit and loss position of the business. Now, what do we include under trading account? The trading account, as you can see, the format of the trading account, it begins with the opening stock. The stock that is remaining is brought down in the current year. The stock that is unused is brought down in the current year to begin with the trading account. We then add the goods that are purchased. Many a times, the purchases are not as per the specification. In that case, you return the goods. So from purchases, we deduct that much amount. The next entry is of wages. You pay wages to the workers. Then customs and import duty in order to get the goods into the godown. You also pay some carriage expenses, some royalties, some manufacturing expenses that you incur in order to manufacture the goods, some packing expenses. So these are the expenses, in short, which are directly related to goods. All the expenses that are directly related to manufacturing or purchase of the goods appear on the debit side of the trading account. As you can see on the screen, we have debited all the expenses on the debit side, that is the left hand side. On the credit side, we first begin with sales. Sales, in short, is an income. Again, from sales, there would be some customers who would return the sales or the goods. So we need to deduct that much amount from the sales. And at the end of the preparation of trading account, we close it by closing stock. The stock that has been unused at the end of the accounting year is called as closing stock. The opening stock is the amount of the stock that was unused at the beginning of the accounting period. And the closing stock is the stock that remains unused at the end of the accounting period. When you total the expenses side or the debit side and the credit side, if the sales, that is the credit side, exceeds or is more than the debit side, that is expenses, then you get a gross profit, which eventually you transfer to the profit and loss account. And in another case, where the purchases side or the debit side exceed the credit side, then you get a gross loss. So gross loss appears on the credit side in case the purchases or the debit side is more than the credit side. In short, when the income is more than the expenses, you get a gross profit. And when the expenses are more than the incomes, you get a gross loss, which is eventually transferred to profit and loss account. So in front of you is the format of trading account. As I already mentioned, that trading and P&L account or profit and loss account are prepared in one format, one below the other. So this is the format of trading account that we discussed. Let us move on to the profit and loss account format. So in the profit and loss account, which also shows all income and indirect expenses related to business. I already mentioned that the trading account shows the direct expenses, the expenses that are directly related to goods appear in the trading account, and all expenses and income that are indirectly related to business appear in the profit and loss account. What do we mean by indirectly related? Indirect expenses include those expenses such as office, administrative, selling and distribution expenses that are required for the maintenance or operation of the business. So profit and loss account provides net profit earned or net loss suffered by the business. In the similar fashion, the way we discuss trading and profit and loss account, if the expenses exceeded the incomes, we get a loss, And if the income exceeded the expenses, we get a profit. In the same pattern, we deal with the profit and loss account. Let us have a format of profit and loss account. As you can see on the screen, on the debit side, we have all indirect expenses. Indirect expenses mean expenses which are indirectly related to the maintenance of the business or the operation of the business. Like for example, salaries. You pay salaries to the employees. You may pay some rent, commission. You may spend on the advertisements to expand your business. You incur certain losses in the form of bad debts. You may give or extend some kind of discount to your customers, which is also a business loss. And on the credit side, you can see that you may get certain interest. You may get some indirect incomes as well. So you may earn some kind of interest, maybe from the bank. You may also get some commission, some discounts from your suppliers maybe. So these are the incomes and these are the expenses appearing on the debit and credit side. So debit side, you have the expenses which are indirectly related to your production or they are related to the maintenance or operation of the business. And on the credit side, we have the incomes which are indirectly related. We bring down the gross loss from the trading and profit and trading account. If there is a loss, in case we have incurred a profit from the trading account, then we bring down the profit on the right side. Finally, after balancing the profit and loss account, either the debit side is higher or the credit side is higher. So if the debit side is higher, that means the expenses are greater than the incomes. So when the expenses are greater, you get a loss. When the income side is higher, you get a profit. So in the similar pattern, you need to transfer either the net profit or the net loss to the capital accounts. The capital accounts will be shown in the balance sheet. So this was all about trading and profit and loss account. So these are the items that we just discussed which appear on the debit side of the profit and loss account. You first transfer the gross loss which you bring down from the trading account on the debit side. Then the next thing is salaries. It refers to the amount paid to the employees, which is indirectly related to the business. Interest paid, it refers to the amount paid as interest on loans. Commission paid, it refers to the amount paid as commission to the agents. The other trade expenses refer to the amount spent on various number of small but important expenses related to business. These trade expenses can be printing and stationery. You spend on printing of bills, invoices, registers, etc. Advertisements, it refers to the amount spent for attracting customers to buy the products. Bad debts, it refers to the amount which is not paid by the debtors to whom the goods were sold. So we take it as and consider it as a business loss. Then the discount, it refers to the amount which is reduced from the list price of the goods. So whatever is the list price, the listed price, you offer some kind of a discount, maybe cash discount or trade discount to your customers. If the customer is paying in cash, you offer him a cash discount. We now discuss the items which appear on the credit side of the profit and loss account. The gross profit will appear on the right side, which is transferred from the trading account. Interest received is the amount that is received as interest on investments, the investments that the business makes. Commission, it refers to the commission earned by the business for giving business to others. So there is certain amount of commission which you are receiving, which is also an indirect income. Let us discuss now about the second statement under final accounts, which is the balance sheet. Balance sheet is a financial statement that states the financial position of the business. It lists the assets and the liabilities of a business on a particular date. We considered expenses and incomes under profit and loss trading and profit and loss account. So the remaining is the assets and liabilities. So all the other items will appear in the balance sheet. So balance sheet lists the assets and the liabilities of a business on a particular date. Now assets and liabilities on a balance sheet are listed in either of the two orders. One is liquidity order and two is permanency order. We shall not go into depth of studying these two orders. We first need to understand the simple preparation of the balance sheet. So this is the format of the balance sheet, as you can see on the screen. As you see on the left hand side are the liabilities. And even before that, if you see the format of the balance sheet, we always write balance sheet as on a particular date. For example, if you are preparing a balance sheet, the accounting period 31st March 2020, then you are supposed to write balance sheet as on 31st March 2020. There is a specific accounting period for which you are preparing this balance sheet. So at the end of the accounting period, this is the position of the business. On the left hand side, as you can see, we have the liabilities. We have already discussed what are assets and liabilities in our previous sessions. So if you just note down, we have bank overdraft, outstanding expenses, bills payable, sundry creditors, loans and capital on the liability side. Coming to the asset side, on the right hand side, as you can see, we have cash in hand, cash at bank, prepaid expenses, bills receivables, sundry debtors, closing stock. Closing stock will include raw material closing stock, work in progress closing stock, finished goods closing stock. And then towards the end we have plant and machinery. A balance sheet will always balance the debit and the credit sides. Both the sides will eventually tally and balance. We have certain adjustments. The adjustments are those transactions which relate to the accounting period for which financial statements are being prepared that are not included in the trial balance. So any transactions which are not appearing in the trial balance appear by way of adjustments. Many a times the occurrence of the transactions happen after preparation of the trial balance. So in that case, the trial balance will not have the account of these transactions. This is the reason why the transactions are entered via adjustments. So we are not going to study more in detail about adjustments right now. So just to recap, today we studied about the preparation of trading account, trading account, profit and loss account, and balance sheet. Hope you have understood the entire session. Thank you.